You've likely come across the saying, "Let your money work for you." It's a phrase tossed around in personal finance books, seminars, and YouTube videos, promising a path to wealth through the magic of compounding. But what if I told you that money is a lazy worker unless you hand it a massive paycheck up front? Compounding is often sold as a miraculous force, a financial fairy tale where patience and discipline guarantee riches. Yet, when you crunch the numbers, the reality hits hard. No matter how clever you are, how frugal you live, or how early you begin, none of it matters without one critical ingredient: a substantial sum of money. And here's the kicker: no one tells you this up front. It's not about greed or wanting more than you deserve. It's about the raw physics of wealth building. Let me introduce you to Andy, a 27-year-old who embodied the ideal of financial discipline. He lived modestly, skipped overpriced lattes, and committed to investing $200 every month without fail. Andy devoured personal finance advice, followed every guru's playbook, and stayed the course like a monk dedicated to a vow. After 12 years of unwavering commitment, he opened his investment account and found $38,000 staring back at him. Stunned, he wondered, did I mess this up? The truth? Andy did everything right. But here's the harsh reality. Compounding is like rolling a snowball down a hill. No matter how perfectly you shape it, if you start with a single snowflake, it's not going anywhere. Andy wasn't lazy or reckless. He was undercapitalized. And nobody warned him that compounding tends to punish those with modest means long before it rewards the wealthy. You might be thinking, wait, are you saying compounding is a scam? Not quite. But if you've ever wondered why the rich seem to amass wealth at an alarming rate, even when they start investing later in life, this is for you. Today, we're diving deep into why compounding only truly works when you have a large sum of money to start with, and why it's not the passive, magical process it's made out to be. We'll unpack the myths, expose the half-truths, and lay out a roadmap to make compounding work for you. Let's begin with the first hard truth: the illusion of starting early without scale. You've heard the mantra, start investing early, and you'll retire a millionaire. It's repeated endlessly by financial advisors, bloggers, and well-meaning relatives. But this advice is only half true, and that half-truth can be dangerously misleading. Time is indeed a powerful factor in compounding, but it's useless without a partner, scale. Picture dropping a single raindrop onto a trampoline. It barely makes a dent. Now imagine hurling a bowling ball onto it. That's what a large sum of money does to the compounding curve. It gives it the weight to bend the trajectory in your favor. Without that weight, you're stuck playing a long, frustrating game with a rigged set of dice. People love to point to Warren Buffett as the poster child for early investing. They'll tell you he started at age 11, implying that his billions are the result of a head start. But let's be real. Buffett's fortune didn't explode because he tossed a few bucks into the market as a kid. The real magic happened later, when he controlled massive amounts of capital. A staggering 99% of his wealth was built after he turned 50. Why? Because that's when compounding had enough raw material to work with. Time is only transformative when paired with what I call capital density, a hefty sum that gives your investments enough mass to generate meaningful growth. Here's where the trap lies. If you diligently save $100 a month and earn a respectable 10% annual return, you won't be a millionaire in 20 years. You'll have about $75,000. That's not financial freedom. That's barely enough for a decent used SUV. The cold truth is that compounding isn't a game of patience alone. It's a game of positioning. If you're not working toward a substantial capital base, you're not really compounding. You're just saving with a bit of flair. Let's dive deeper into why this matters. Most financial advice glosses over the need for scale, focusing instead on discipline and consistency. While those are important, they're not enough. Compounding rewards size far more than it rewards effort. To illustrate, let's look at how the wealthy approach compounding differently. They don't sit around waiting for their small investments to grow over decades. They trigger compounding by deploying large sums up front. While the average person might invest $50 a month, hoping it snowballs over 30 years, the rich drop $50,000 or more in a single move, compressing decades of growth into a few short years. This isn't luck or privilege at work. It's strategic leverage, not the kind that involves borrowing, but the kind that comes from wielding a large capital base. A big sum doesn't just grow, It grows aggressively because the timeline and the dollar amount are aligned. Think of it like planting a tree. A person with modest means plants a seed and waits 30 years for it to bear fruit. A wealthy person plants a mature tree and enjoys the harvest next season. Both are labeled investing, but only one delivers results within a lifetime. This is where mainstream financial advice often falls short. It tells everyone to invest, but it rarely emphasizes that what you invest matters far more than when you start. The wealthy understand this instinctively. They don't trickle money into their portfolios, they flood them. Bonuses, business profits, inheritances, whatever resources they have, they channel them into their investments early and often. This isn't about impatience. It's about understanding that time multiplies capital, not effort or sacrifice. The larger the initial sum, the faster compounding reveals its power. If you've been led to believe that compounding is a patient person's game, it's time to rethink that narrative. Compounding is a tool, and like any tool, it's only effective when you have something substantial to work with. Now let's flip the coin and examine why small, incremental investments often waste more time than they're worth. Most people don't fail financially because they're lazy or irresponsible. They fail because they follow the rules to the letter. They create budgets, cut out luxuries, skip vacations, and faithfully invest a small amount each month into a retirement account. Yet, year after year, they remain stuck. Why? Because the financial system quietly rewards volume, not virtue. When you play the long game with tiny numbers, compounding feels less like a magic trick and more like a treadmill stuck on the slowest setting. Let's break it down with numbers. If you invest $200 a month at a 10% annual return for 30 years, you'll end up with roughly $400,000. That sounds impressive until you factor in inflation and taxes, which could easily reduce that to the equivalent of $250,000 in today's dollars. That's barely enough to retire comfortably, let alone live the life of financial freedom you were promised. And yet, we're told this is the smart plan. But smart for whom? It's smart for financial institutions that collect fees on every small deposit you make. It's smart for authors and influencers who profit from selling books and courses about discipline while quietly investing their own large sums earned from royalties or speaking gigs. Small-scale investing isn't inherently bad, but relying solely on it is a trap. It creates the illusion of progress while delaying meaningful results. People dedicate decades to doing the right thing, only to reach their 50s or 60s with a portfolio that's just enough to make them nervous about outliving their savings. They didn't fail, the system failed them. It sold them the dream of compounding without mentioning that the engine runs on scale. The point isn't to shame those starting small. It's to highlight that without a deliberate plan to scale up, you're not truly harnessing compounding. You're just practicing for the real game. This realization demands a radical shift in mindset. Instead of asking, how long will it take to build wealth? Start asking, how big can I make my capital base and how fast? That's the moment compounding stops being a distant theory and starts becoming a tangible path to financial independence. Let's move on to how high earners bypass the waiting game entirely and why emulating their approach could help you escape the slow lane. Most people believe wealth is the reward for patience, but high earners don't play that game. They accelerate. They don't sit around hoping their $100 monthly investment will grow into a fortune over decades. Instead, they focus on creating large sums early and injecting them into the compounding engine before most people even realize the race has begun. This is how the rules of wealth building shift. The secret lies in building capital momentum first, and then letting compounding take over. Consider professionals like surgeons, software engineers, or entrepreneurs. They don't invest small amounts for 30 years. They pour significant sums into their portfolios for 5 or 10 years and then let time do the heavy lifting. They understand the exponential difference between a $100,000 seed and a $100 drip. Here's what most people overlook. You don't need to be born into wealth to make this work. The key is developing a skill set, business model, or income stream that allows you to generate a substantial capital injection quickly. Once you have that, compounding becomes a powerful amplifier, not a last-ditch savior. This isn't about comparing yourself to someone earning $300,000 a year. It's about adopting a blueprint for action. Whether it's through a freelance gig, real estate ventures, or a side hustle that gains traction, The goal is to shift your focus from pinching pennies to creating sizable capital chunks. Every wealthy person you admire made this mental switch. They stopped measuring their progress by the passage of time and started measuring it by the velocity of their capital. This is when financial freedom starts to feel within reach. Once you grasp that compounding thrives on large sums, the question isn't how long do I have to wait, but how quickly can I scale my seed capital? Now, let's explore how the wealthy protect these large sums from erosion, because building capital is only half the battle. For the rich, the real game begins once they've secured a substantial sum. Compounding doesn't just depend on how much you invest. It hinges on how long you can keep that capital working for you. Nothing derails compounding faster than losing your principal. That's why the wealthy aren't solely focused on chasing high returns. They're obsessed with preserving their capital. Warren Buffett's famous investing rules sum it up perfectly. Rule number 1, never lose money. Rule number 2, never forget rule number 1. It sounds almost too simple, but the deeper meaning is profound. Compounding only works when your capital remains intact. You can't grow what you've lost. While the average investor chases 20% returns by jumping on the latest trendy stock or crypto, the wealthy take a different approach. They quietly shield their money using stable, diversified assets like index funds, real estate, or tax-advantaged accounts. They don't interpret taking risks as making big, reckless bets. For them, it's about achieving consistent, risk-managed returns. They'd rather earn a steady 7% annually for 30 years than swing for 25% one year and lose 15% the next. Why? Because they know that stability fuels compounding, while volatility resets the clock. The path to wealth isn't about chasing explosive gains. It's about sidestepping the landmines that can blow up your principal. Once you've built a large sum, your top priority is to defend it. Every dollar you preserve is a soldier fighting for your financial future. Let's take this a step further and talk about the most overlooked compounding engine the wealthy use. One that has nothing to do with the stock market. When people think of compounding, they picture interest rates, mutual funds, or stock charts. But the richest individuals know there's a more powerful force at play, and it's not tied to Wall Street. It's within you. Skills, when deliberately developed and applied, can compound faster and more reliably than almost any financial asset. A single high-value skill, whether it's copywriting, coding, negotiation, or sales, can double or triple your income in less than a year. That boost isn't just money in your pocket. It's future capital that opens doors to investments, opportunities, and strategic freedom. The wealthiest people didn't start with a silver spoon. They started by compounding their knowledge and monetizing it until they could generate the large sum that changed the game. Here's a truth rarely discussed. Compounding works so well for the rich because they invested in themselves first. They created leverage not through luck, but through layered skill sets that produce value on demand. Look at any self-made millionaire, and you'll see the pattern. Before their wealth grew, their ability to earn did. Compounding didn't begin with stock dividends or bond yields. It started with sharp decision-making, calculated risk-taking, and relentless skill building. If you're frustrated with your slow financial progress, ask yourself this. When was the last time you invested in a skill instead of a stock? A $500 ETF might grow 8% in a year, but $500 spent on a high-impact course or mentorship could 10x your earning potential. That's the kind of compounding the financial industry rarely talks about, because it doesn't generate fees for them. Let's tie this all together with a final, sobering truth. The reason most people never build wealth through compounding is that they're sold a lie. That patience alone will make them rich. The financial world pushes the idea that starting early is the golden ticket, but that advice only works if it's paired with scale. Without a large capital base, time becomes a slow, grinding path to almost enough. People do everything right, save diligently, live below their means, invest consistently, and still find themselves at 60 wondering where the promised freedom went. The lie is that compounding is always working in your favor. It isn't. If your starting point is too small, you're compounding frustration, not wealth. To break free, you need to stop thinking of compounding as a passive, magical process. It's not a slow cooker that delivers riches if you just wait long enough. It's a force multiplier, but it only works when you feed it something substantial. So what's the solution? Stop waiting for someday. Focus on building a large sum through high-value skills, income leaps, strategic systems, and capital preservation. Create weight, capital weight, skill weight, system weight, because when you do, compounding transforms from a distant hope into a powerful weapon. The game was never about time alone. It was always about scale. In closing, the truth about compounding is that it's not a fairy tale. It's a tool that rewards those who position themselves with intention. It's not about starting earlier or grinding harder. It's about building momentum and giving compounding something to work with. When you hit that critical mass, the rules change. Your money doesn't just grow. It multiplies quietly, powerfully, and predictably. If this resonates with you, let it be a wake-up call. Stop chasing outdated advice and start building intentional scale. Compounding isn't magic, but with the right weight behind it, it can feel like it.